Welcome back to the Finance Corner. So this is going to be the next update video in our option series, and let's get right into it, right? So we're not looking too good. We are not looking too good here. So we started off this account with 7,500 bucks. Then, again, the goal, as always, is to generate income in this account using the wheel strategy with options. So just a quick overview of how we got to where we are right now. Let's go right into it, into this account history. So a couple things have happened um, since we started this account. Yep, there we go. So the first thing we did was let me just explain how we got to where we are and why we're down a little bit right now. So we first sold a put for $21, and I think this is 2 weeks out strike price, and $21 strike price, 2 weeks out expiration. We got paid $2.85, excuse me, for that, which was 95 cents for each contract because we got 3 contracts, and we ended up expiring in the money on that contract. So that means that we are going to get assigned those shares at $21, and that's where this line is explaining here. So it took away the money and bought shares. And we owned those shares at $21. Now, here's what's cool about the wheel strategy. The next thing we did was, now that we have 300 shares, let's go ahead and write covered calls on it, because now we can get paid to sell those shares. So that's essentially what we did. Our cost basis, I think, oh yeah, so our cost basis was originally $20.05, because the strike price is 21, yes, but we got paid 95 cents. So you do the math out there, 21 minus 95 cents gives us $20.05. So now, or on February 13th, the goal, you want to be able to sell calls or sell your shares above the strike price, or sorry, above your cost basis. So we established our cost basis $20.05. So now on this February 13th, we actually wrote another call for $20.05. So you see it's above our cost basis, and that's what we ended up doing. So we ended up writing a call for $20.05 strike. I think this is another 2 weeks out, and then we got paid 69 cents for those shares or for those contracts. And then it was actually good that it expired out of the money, so we were able to keep the $207, and we were able to just keep it and go on to the next thing. And then since I'm holding shares, we actually got paid a nice little dividend. And now let me fast forward to explaining why we're actually down. We're down because Kohl's is down itself. So again, our cost basis was roughly started off at $20.05, and then we started writing calls to lower our cost basis. After that first call that we wrote, we got paid the 69 cents, I think it was. Yep, we got paid the 69 cents. That was going to bring our cost basis down. So you see $20.05 minus 69 cents is going to bring our cost basis now to $19.36. So we're still down because Kohl's decided to not respect the trend line that I had here. It's like, bro, I went through the trouble of drawing this line, and then the price doesn't want to respect it. I don't know what that's all about. But anyways, so you can see how we had the all-time low here, $6. We're kind of trading higher. And for a moment, it looked like the price is going to respect the trend line here. For a few weeks, we actually started going up a little higher, and then the market said, nope, we're going to destroy this trend line. I don't care about your lines. Let's go down back to $13. So that we're down a solid, like, what is that, like 30, 33, 34%, as you can see. So that's why we have only like 5,500 in our account right now. But yeah, it's all good. It's all good because we are going to keep this account going. We still have a little bit of purchasing power left, and because at this point, our goal is to just wait. Really, like we just have to wait until Cole's shares recover a little bit, at least a little closer to our cost basis, and then we'd be able to start writing calls again um, to collect that premium, and then we'll be happy because we'll have made our money back. But to be honest, I think I mentioned it in a previous video. I don't mind holding calls. Only problem is I'm trying to make content on this account, right? So if I have to end up holding this for like 6 months, then it's not going to be as much content we can make. So what we're gonna do is tomorrow. Today is Thursday, March 26th. I think tomorrow I'm going to write another contract because we do have a little bit of purchasing power in it. What I'm gonna do is start running the wheel on the energy company that I was looking at before, or I mentioned in a previous video, UUUU, and we're gonna take a look at those options and see if we can generate some premium. Before I go into explaining that company, it's gonna be a little bit of a shorter video. I'm just gonna explain how. So our cost basis was $19.36 on the 300 shares that we own, but excuse me, that was after we sold the contract. Excuse me, that was after we sold this $20.05 contract and got paid our 69 cents. That brought our cost basis down to 1936, right? But we also got paid we also got paid dividends on the shares that we have. So we got paid 37.50, $37.50. So what we're gonna do really is we're just gonna add this into our cost basis because this brought down our cost basis. So what we're gonna do is we're gonna say 1936, and we're not gonna subtract that by $37 because you gotta remember options are leveraged. So really, it's gonna be like 37 cents. Yeah, roughly 37 cents because we moved the decimal place over 2 times. It's gonna give you 0.37. So 1936 minus 0.37, 0.38, whatever you want to call it. So now we own the shares that we own. The 300 shares we own are now really our new cost basis is at $18.99. Let's just call it $19. So we're gonna put that line somewhere close to 19. Yep. And then we're gonna add, where is it? Coordinates, $19. Boom. So, as you can see, originally we started. This is why I like kind of like the wheel strategy because it's like originally we owned these shares at like $20.05. When you combine in the premium that we got paid, we own these shares at $20.05. Then we started writing covered calls to lower our cost basis, and we also got paid a dividend. As you can see here, the ex-dividend date was on the 18th. So we got paid a dividend, which also is going to lower our cost basis because now we're holding shares. So our new cost basis is $19, but as you can still see, we're clearly, Cole's share price is clearly well below our cost basis. So we're just going to be down for now. And that's why we are down on the account. But that is pretty much where we're at. That's pretty much where we're at with the Cole strategy. Still holding with the wheel strategy, we're still holding shares. So as you can see, we're holding the 300 shares here, and I'll be good on that. So what I do plan on doing though, just so this account is not sitting and holding shares for 6 months or 8 months, I'm actually going to write puts on UUUU, which is energy fuels. So let me give you a brief breakdown of energy fuels and what the company does. So I have some notes here. So Energy Fuels is a US-based producer of uranium, rare earth elements, and other critical minerals, with a strategic focus on supplying the nuclear fuel and clean tech supply chains. So the core business is exploration, development, and the sale of uranium properties in the United States, making it one of the leading domestic uranium producers for the nuclear fuel cycle. Other products, it doesn't only deal with uranium; it has a bunch of other rare earth metals, rare earth materials that it produces. So these will include ilmenite, rutile, zircon, monazite, and yep, you can look up like whatever the hell those things are used for. But benefits from the growing interest in nuclear power as a low carbon energy source, driving demand for domestically sourced uranium. Because I think we still kind of get a lot of products and stuff from China. I think energy is one of them, or at least uranium. So it's like if we can have a producer in the United States that can bring all the energy that's going to be used to build out AI infrastructure, if we can have that be produced domestically instead of having to import from China, that could be a great thing for United States overall, the United States economy. So, um, critical minerals theme. So it positions itself as a U.S. supplier of strategically important minerals, uranium and rare earths, aligned with Western efforts to secure non-Chinese supply chains. Roughly trading around $17 right now. And now we can actually take a look at the chart, because what I plan on doing is actually writing a contract tomorrow before the week is out. Since today is Thursday. So, yep, this is Coles. Let's take a look at the price chart of UUUU. And then, bam. So this chart or this stock is extremely volatile. It is extremely volatile, as you can already see. Like in the span of less than a year, it's been as low as $3.20, and it's been as high as $27.37. So you can see this the volatility here. That's up like 780% in less than a year. Like this is ridiculous, right? So if we actually zoom out a little bit, the reason this could be potentially a good long term is you can see how, like, maybe not long term, but you can see how this stock has it's like stayed relatively not flat, but in a range of like $11 to like $5 for a good 5 years after the pandemic here. So I'm talking about this zone here, and then after consolidating for so long, it actually decides to just you know uh, take off, and I think this is because of all the energy demand that people and investors are realizing that will be needed for AI and building out AI infrastructure. So now it's going to be looking at like what companies can produce this stuff, right? So I think this is kind of where we had this extreme volatility come into play on this stock here, and you can see on the monthly chart. Let me see. I don't know if we're at all time highs yet. Okay, this stock has been much higher. Oh wow, this stock has been as high as 240 right at the peak of the financial crisis in 2008 or 2007, and then it crashed. This is actually very interesting. It's actually very interesting. This chart, this company crashed to the tune of like 97% after 2007, and then it's been flat for what is this 20 no 10 years. It's been flat for 10 years, and then now we're getting kind of like some momentum in this. So this is not a bad company that to run the wheel strategy on. This is what I was doing some research on, because I'm gonna look into options right now and show you that their premiums are pretty juicy. They're pretty healthy, and it makes sense, right? Because they have such high implied volatility that they kind of have to pay you for playing around with these contracts on this stock. So I did a brief technical analysis here. It's like, if I could just explain this, I think that, you know, we made the peak here, October 2025. We came back down, and we kind of respected this, what I would call institutional candle. And you see how we barely tapped into that. And then from there, we started trading a little bit higher, broke that previous all-time high, made an, or not all-time high, but broke that previous high, and made a new high of around like $28. And we also left this imbalance here. So the reason why I think it's gonna be a good time to start writing contracts or writing puts on it is because basically I think that this could be a support level. The market moves in waves, right? We already know the market never just goes up and it never just goes down, right? It's always somewhere in between. Anyways, I think that this could be a good area to start selling puts. Start selling puts on. So basically what I'm gonna do is maybe I'll look at the $18 strike price, 19. I don't know, but I think that we can be bullish out of here. So what I'm gonna do, let's look at the actual options chain real quick. Look at the actual options chain real quick. Where we at? Let's look at you. And so basically, this is going to be the goal. Tomorrow, I'm going to write a contract. I think I'm only going to keep it simple and only because I did enable margin on this account, but I don't want to be too heavily over leveraged. So I might just get one contract. As you see, my buying power is way over the amount of money that I actually have. So yeah, let's see, trade UU options. And we're gonna do is we're gonna go 7 days out. We're going to sell a put, and then we have the options chain here, the beautiful options chain here. So you see the share price is currently at $17.08. I don't know why it's on the call side. I want to sell a put. Okay, $17.80. So yeah, I'm looking at this, and I wouldn't mind. Let's see. I don't want a delta of above 60. So I think this is around this is good. I think I'm gonna write this contract here. So essentially it's the writing the strike price of $18.05. And so the end goal of writing this contract is by the time expiration date, we want it to be above $18.05, because if it's above that, we get to just keep our $1.31, and then we move on to the next one. But you see how high the implied volatility is? Like, look at these Greeks real quick. Delta, remember, it tells us how sensitive the contract is to the underlying share price movement. 0.6 it's pretty kind of higher, but like I'm actually going for a higher premium, so this would kind of make sense for me. But look how 100% implied volatility, so this thing could go anywhere by next week. So it is what it is, but this is the contract I think I'm gonna write, and then we're gonna get paid $1.31 for it. So as you see, the total credit is gonna be $1.31. Or remember, we're playing with remember, we're playing with options, so it's $1.31 times 100, which means we'll get paid $131 for writing this contract, and then that's it. We move on to the next one. We can do more than one contract, but I think I'm just gonna do one. See, so just so you see exactly how I can't even put it through because the market's closed right now, but so you can exactly see what I'm gonna do tomorrow. I'm not gonna go for the lowest price. I'm gonna go for somewhere in between, like $1 and. So you see the limit price here. The bid is 131. The ask is 160. You can go for 160, but it's gonna be a low chance for it to get filled. So I'm actually gonna go somewhere in between. I'm gonna do like $1.45. So we should be getting paid $145 for this for each single contract that we write. And so yeah, these are cash secured puts. So I need to have at least, what's the strike price? Or it tells you here, I need to have at least $1,700 in my account here to be able to open the trade. Because in a cash secured put, in the event that the contract expires in the money, you need to have the money to be able to, fulfill your obligations. So that's how much I'm gonna need. And then yeah, we can write like three. We can write more than one contract. I think my buying power is like 8,000. So it's like if we wanted to, you know, that'd be like $5,000 you need to have in order to write the contract. But we get paid $434. Now I'm not going to go crazy with the leverage here. Let's see. Can I write two? I don't know. Nah, I'm gonna keep it simple because this is gonna be the first contract that I write on this one. So we're just gonna write one contract, get paid our $145, and then hopefully by the time next week, April 2nd, price is above it, and we get to keep our $145 and then keep it going. And then at this point, we're gonna try to get our money back, or try to generate some income on the money that we do have, while we're holding Cole's shares. And hopefully that will appreciate and get us back to our break-even price. So that's pretty much the goal of where we're at here. That's my plans going forward tomorrow. And, we'll be back close around the expiration date for that contract to then see how it played out. So catch you guys on the next one, and thanks for watching. Peace.